This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this monthly market and economic update for August 2025. In this video, we'll discuss August's market performance and what it means for investors moving forward. Despite significant policy uncertainty around tariffs and ongoing concerns about Fed independence, both the stock market and bonds delivered solid returns last month. This performance highlights an important lesson for long-term investors about staying focused on fundamentals rather than getting caught up in daily headlines. The S&P 500 climbed 1.9% for the month, bringing its year-to-date return to 9.8%. Bonds also contributed positively, with the Bloomberg U.S. Aggregate Bond Index gaining 1.2%. International markets showed particularly strong performance, with developed international markets jumping 4.1% in dollar terms, while emerging markets gained 1.2%. For the year, international developed markets are up an impressive 20.4%. Now, let's get into what drove these returns. While headlines about tariffs and policy changes can create short-term volatility, it's earnings and valuations that drive long-term stock market returns. This earnings season demonstrated exactly that principle. According to FactSet, 81% of S&P 500 companies beat earnings estimates. This is the highest percentage since the third quarter of 2023, showing that corporate fundamentals have been stronger than many expected. This also demonstrates something important about corporate adaptability. For the time being, companies are finding ways to adjust to tariffs, absorb higher costs, and continue growing despite policy uncertainty. The Magnificent Seven technology companies, which now represent over one-third of the S&P 500, had mixed results overall. However, some of these companies did exceed expectations, helping to calm investor concerns about a potential AI bubble and driving a market rally in the second half of August. Let's turn to Federal Reserve policy, which was another key market driver. Fed Chair Jerome Powell provided the clearest signal yet that the central bank is prepared to resume cutting interest rates in September. This is because economic data has been mixed. While GDP growth for the second quarter was revised higher to 3.3%, the July jobs report showed the economy added only 73,000 jobs, with significant downward revisions to prior months. So what do potential rate cuts mean for investors? Lower rates can create opportunities across asset classes. They support broad economic growth, improve borrowing costs for companies, and increase the present value of future cash flows. For bonds, lower interest rates can boost the prices of existing bonds that were issued at higher yields. As we look ahead, investors will continue to face headlines about tariffs, Fed policy, and other policy issues. Rather than trying to predict the outcome of each event, the key is preparation. Maintaining a truly diversified portfolio that is positioned for a range of possible outcomes is key. Yes, we always hope for the best outcome, but hope is not a plan. At Dynamic Wealth Group, we work with financial advisors, helping them build asset allocations with multiple drivers of return, not just stocks and bonds, but incorporating different approaches and disciplines, along with utilizing alternative investments that strive for non-correlated returns. Now, I hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our white paper. You can click the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.